Hi there and welcome to a brand new edition of Who Moved the Market. I'm your host, Surabhi Upadhyay. Well, today, Thursday, was going to be all about the RBI policy, and that's exactly how the day has played out. And markets have been reacting. In fact, equity markets have been reeling under pressure. One justification could be that on Wednesday, the market perhaps got a little too hopeful and maybe started expecting, a less hawkish or maybe even a dovish policy from the RBI. And that's not exactly what has been delivered. The net result on the screen right now as we speak, and we're recording this at around 2 o'clock on Thursday, is that the Nifty is selling off and banks are selling off big time in the equity market at least. But really, what is the big issue? The central focus of the policy and the chatter over the last couple of days has been inflation. And we heard a lot of that in the commentary that came in from the Reserve Bank today. So to help us make sense of all this inflation talk and a kind of crystal ball gaze into the future as well, to see if this is just a one-off reaction that we're seeing in the markets today, or maybe there's a bigger worry ahead. Well, to help us make sense of all of these things, I have with me Mr. D.K. Joshi, who is the Chief Economist at CRISIL. Dr. Joshi, thank you very much for joining in. Great to have you on the show, and welcome to your first ever digital appearance on CNBC-TV18's Who Moved the Markets.
Thank you.
Okay, so let me straight away dive in. I think today what we saw in the market was perhaps a little on the expected lines, right? We went in knowing that inflation is a problem, and that's exactly what the RBI governor acknowledged as well. What did you make of the announcements?
Well, I think if you look at even the June policy, the central bank was very cautious as far as inflation is concerned, and they were reiterating that they want to align it to 4%, which is their eventual target. So there was a hawkish tone even then when inflation was supposed to have peaked out. And now I think we are seeing a buildup of inflation. It printed 4.8% in June, expected to cross 6% in the month of July. Actually, RBI has raised its inflation forecast for the second quarter by a full 100 basis points from 5.2 to 6.2%. So clearly, I think inflation is a worry. And I think on top of that, they have also, the policy announcement was not a surprise. The surprise was the incremental CRR being bumped up from 4 to 10. Now, that actually temporarily creates slightly tighter liquidity conditions at the short end. So what we might see is that the short end of the yield curve might see some hardening, but this is purely transitory. I think they are trying to do it. They will reverse it, I think, somewhere during the festival season, so that more liquidity becomes available. I think this is a move basically to suck liquidity out because I think a lot of liquidity had been created because of return of 2,000 rupee currency note.
Yeah. Sure, and that was the other important part of the policy, and I want to address that. I'll come to it in just a bit. This new concept of this incremental cash reserve ratio, or ICRR as it's being called now. More on that in a bit, but just to talk about inflation a little further. So the Reserve Bank has raised its own estimates for all the quarters, right up till the first quarter of next year now. And I think another factor is that the Reserve Bank has very clearly said that in the second quarter, CPI inflation will cross its tolerance limit of 6%. Now, how should one read this? And I mean, as of now, on rates, absolute status quo. Let's leave aside the CRR bit for a second. But, how would you interpret this in terms of the next few moves as well, the next policy onwards?
Well, I think, you need to dissect inflation a little bit and look at its components. Right now, I think the fuel inflation is in low single digits, but crude prices are rising. So there is some worry on that front. As far as the core inflation is concerned, which is of great relevance to RBI, I think that is sticky, but it has come down by about 100 basis points over the last couple of months. And their goods part of the core inflation might come down further. Services might remain a little sticky because of high demand for services right now. Now, coming to the big problem area, which is food, and which is the most volatile and very difficult to predict component of inflation. There, I think we are seeing two things. One is the food grain part of food inflation, which is cereals, pulses. That is seeing continuous pressure for the last couple of months. Now, what added to the problem was the vegetable inflation, which joined the bandwagon, and actually tomatoes were in the
They made
news.
the headlines,
But
yes.
yeah, then I think it could. I mean, the pressure point could be on onions also going ahead, I think. So clearly, the vegetable part of the food inflation is a bigger concern right now, because the double-digit inflation in cereals we had been seeing for quite a few months. The issue is that the central bank can look through vegetable inflation because they have short crop cycles, and I think it goes up very sharply and also comes down. Don't forget that tomato was in the wholesale market was selling at 2 rupees a kg a couple
Right.
of months back. So there is a lot of volatility. But I think if food inflation persists, then I think it is about 40% of the total. It has 40% weight, and it is quite large to move the inflation in outside RBI's comfort zone. So I think central bank has to be very cautious and watch it very closely how this plays out. Now, this depends partly on the monsoons, partly on El Nino, global
Sure,
factors. So
sure.
it's a very complex web of things which will decide how the food inflation moves. So your
Sure.
policy will be essentially data driven, and you'll have to keep reacting to how the data plays out.
No, absolutely. And it's really important that you mentioned that 40% comes in from food inflation. So it's not like it's only a political headline or news headline and you can ignore it from a policy standpoint. So food inflation is important. So let me ask you the harder question. I mean, from whatever statistics that you look at, perhaps, are there any indicators that can give us some guesstimates as to what is happening with food inflation? Like you mentioned, maybe on vegetables, we'll have onion prices moving higher. What about cereals? Any indicators right now to give us a peek into what lies ahead?
Well, right now, I think there is clearly pressure on whether it is rice, because I think the news also creates pressure at times. I think there is a fear that El Nino can impact rice production in Thailand, for instance, or palm oil production in other parts of East Asia from where we import. So there are these kind of things also create pressure points on food inflation. But having said that, I think we need to watch out for three things. One, how does the rest of the monsoon season plays out, which is August and September. The IMD expects somewhat drier conditions here. Then I think we need to see whether we'll get enough imports of pulses, because pulses inflation is in double digits now. I think last year also pulses crop had underperformed. So I think that's the other area. And then I think comes your vegetable prices, which are, as I said, are very hard to predict. And I think you can't. There's no way to forecast that. I think the tomato will. I think all I can say is that going by the past experience, tomato prices will come down. Onions could be under pressure if I think the rains behave, then I think that pressure may not play out. But if the rains are volatile or there is excess rain towards the end of the season after a dry patch, I think all those things create pressure points on crops like onions, because 70% of the onions are produced in the Rabi season, which we are eating right now. And then I think from the October onwards, the Kharif harvest will come. So if Kharif harvest gets disturbed, then I think we could see a pressure point there. So I think what I wanted to say is that the inflation pressure right now is more from idiosyncratic, which I think are volatile components of the basket. And these are very hard to predict. So I think I would say that I think we don't see inflation cross 5.5% this fiscal year. Okay. I think because we do expect the crude prices to remain somewhat softer, and core inflation, because input costs have come down very sharply. So that is getting reflected in the goods part of core inflation and keeping it a bit soft. I think food, well, you have to keep your fingers crossed.
Oh, absolutely. Yeah, and hopefully the other aspects, like you're saying, crude, etc., they will not start pinching, because Brent oil prices have been moving northwards. Now they're at 87, so we need to watch for what happens on that front as well, because we're already dealing with this food problem. So, in the context of all this, global central banks have actually been hiking rates. At least the RBI has been on a pause. And you're saying that inflation, give and take, should be around that 5.5% mark for the full year. Now, if we work with that... Yeah.
So our current forecast is 5%. I think what I'm saying is that we don't see it exceeding on the average 5.5% for this fiscal year.
Okay, fair enough. So let's just work with that forecast for now. And if we assume that, then what should we expect on interest rates for the rest of this year? Is there any possibility that the RBI could, take a slightly more dovish turn, or do you think that their hands will be completely tied because of what's happening with food?
Well, if I look at the central bank's forecasts that were released today, they don't see inflation come down below 5% in any quarter. And actually, in the first quarter of 24-25, they are expecting it at 5.2%. And they are at the same time also reiterating that they want to align it to 4%. So since it is not aligned to 4% as yet, even in their forecast, so that means they will not be in a hurry to cut rates. I think that's one conclusion I reach. And then I think the rate cut we expect in the first quarter of the next fiscal year, which is 24-25, which would be April to June quarter. If I think this forecast does play out and there is no further risk to this.
Sure, absolutely. So that's still a long way off. So the hope of rate cuts gets pushed into the next fiscal year. Got that. Now, just to come back to that other point that you were making, and the reason why perhaps bank stocks are selling off so much today, is this this new concept of incremental CRR. So I just want you to help us understand this and completely demystify it for our viewers who are probably not too well versed with some of this terminology. So essentially, I guess what the Reserve Bank is saying that because of the 2,000 rupee notes that were deposited in the system, there's a lot of excess liquidity, and we should see this as a temporary measure just to mop up that excess cash that went into the system. And if that's the case, since they will review it in September, then is there really a reason to worry on interest rates or yields or banks with their bond portfolios for that matter?
I don't think so. I mean, I think it looks like a knee jerk to me. Of course, I think there will be some impact on short-term yields because there is liquidity being impounded by the central bank. But this is transitory. I think they are trying to even it out. I mean, they want to make sure that the liquidity is not short during the festival season. So I don't see it as a problem. And I think sometimes you have knee jerk reactions, and once I think the understanding plays out, then I think things calm down. So I think I won't take the initial reactions too seriously.
Okay, so final thoughts, Mr. Joshi, then as we wind up, what would you say would be your key sort of watch points as you're looking at some of these macro indicators closely in the weeks and months ahead? What would you keep your eye on the most closely?
Well, I think one factor is from the Western central banks, I think, which have been communicating tighter stance. So whether I think Fed continues with its rate hikes or it stops it or not, I think that has a bearing on others as well. So right now the thought is aligned to the expectation that probably U.S. central bank Fed is done doing interest rate hikes, and they will probably now go into a pause. European central bank will continue to raise rates. Now, I must say that monetary policy is at a very delicate phase globally. If they over tighten, then you enter a recession. If you don't tighten enough, then you enter then inflation continues. It's very difficult to say what will play out. I think so. That's a very delicate phase from the global side, and that can actually have spillover effects for others as well. Now, coming to India, I think what I would watch out for is what happens to inflation pressures from the weather, not only in India but also in countries from where we import items like edible oils, etc. So that is one focus area for me. The second is what happens to crude oil prices. I think don't forget that it is not global demand which is dictating crude prices. It's also geopolitics. So how that plays out, I think we need to watch for that. And actually, if oil comes down, it has many positive spillover effects for a country which imports so much of oil. I think in terms of inflation, in terms of fiscal, in terms of current account deficit. So I think that's the key monitorable in the short run. I think on the growth front, right now there are not much worries. But yes, I think the second half of 23 is expected to see slower growth. in the world, and that is going to spill over to us. Already our exports are not doing well in the goods category. Services exports are also slowing. So if the global growth slows down further, how much further, I think, needs to be watched. So that is also the third factor that I would look at. While I think
Okay, God, that's a lot of variables, a lot of moving parts to this story when it comes to inflation and interest rates. Mr. Joshi, thank you very much for joining in. This was very, very helpful. It gives our viewers a clear insight into, some of these important factors that we need to track with respect to the macroeconomic fundamentals. Thank you for joining in on the show today. Well, hope you found that conversation interesting. So now you know what the RBI said and what impact it has in the near term. Thank you for tuning in. Do keep connected with us. Keep sending us your feedback, comments, and queries. And we are going to see you with another market theme tomorrow.